are you? And where are you going? What do you want?
Hello and welcome to People Making Money. I don't know what goes on with this setup. Every time the microphone secretly moves. It's okay, there we go. So I'm your host, Kevin Bemmel, and I'm here every Wednesday at 10 a.m. Pacific time to talk about job hunting, starting and running a business, and building wealth. So the whole financial side of life. And if you saw the show yesterday, see, I have the Snappy Pattern Media sign back in its proper place. Did you notice me glancing over my shoulder because it was annoying me? Yes. Well, so much for being OCD. So today is our monthly Economic Echoes episode. And I mean, unless you have been living in a cave, as they say, you know that the government was shut down for about a month and a half. And so the government, the Department of Labor has not published economic data in all that time. And indeed, I checked earlier this morning, they still hadn't. So I want to start out by talking about this idea that we have that somehow, if the government has published the data, it is therefore reliable. And this is not so much coming from me, but I recommend to you the very short podcast that UBS, which is a Swiss company it's a large Swiss investment bank that is at last report considering moving here to the United States because of how the Swiss government is treating them. So their chief economist, Paul Donovan, talks about this topic pretty regularly. I would say I listen to him 5 days a week, every weekday. Like I said, the podcast is short, 4, 5, 6, 7 minutes at the most. And in addition to the fact that his humor is very dry and droll, he's just hilarious. It's hilarious to listen to him. He highlights periodically that because of a number of factors, including how difficult it is to get people to respond to surveys, government data is not necessarily accurate, or at least any more accurate or any more accurate than potentially other sources of data might be. And he cites in particular things like employment statistics and such. The government is reliant on employers filling out surveys. The number of employers willing to do that has shrunk dramatically over the last, I think it's been 10, 20 years. And so the reliability of this data is not anywhere near as high as it might have been in previous decades. And so I think we get perhaps a false sense of the economy if all we look at is the Department of Labor data, whether it's employment statistics, whether it's the CPI, et cetera. And so what I'm going to be doing on Economic Echoes here on out is using multiple data sources to look at, I think, fewer aspects of the economic data, but the ones that are probably most relevant to us as we live our daily lives and run our businesses and such. So today I'm going to introduce to you, I think, 3 new data sources that we're going to take a look at. I'm going to kind of orient us to them. And then hopefully starting next month, in December, I'll be able to start showing you how the data compares with government statistics, because the most recent CPI statistic, for example, is still for August. We talked about that, uh, you know, 2 months ago in September. Same with the various labor statistics. So, I want to give us a feel for some of the alternatives out there. And, here's the thing. It's very costly to gather this data, but there are a lot of private organizations that have a tremendous amount of money. And while critics complain that they're biased, et cetera, et cetera, et cetera, I don't know that we could claim that government statistics are unbiased per se, not in the way we think of that. So, and this has nothing to do with complaints about leveled at the current administration, for example, having changed the head of the Bureau of Labor Statistics. It has been the case for quite some time that, um, you know, government is inherently political. Okay, it doesn't matter, who is president, which party controls Congress. These are just the realities of any government system, and so I think we'll be much better off if we draw data from multiple sources, just like hopefully we do our news, because news too has always been biased. I talk to people say, "Oh, I long for the days when Walter Cronkite reported news." Well, I was alive when Walter Cronkite was still reporting the news on, I think it was CBS every night, and my impression as a child was, where we're getting the news straight. But the reality is, even Walter Cronkite had his biases. And so, if we want to truly understand what's going on, we need to gather our news from a range of sources so that we can get a sense of what's really going on. I'm not going to do too deep a dive into this, but I did listen to a podcast now, I think it was maybe a few weeks ago, and the fellow was talking about how a statistic or a piece of news will be released, and what'll happen is most of the major news, reporting groups, whatever you want to call them, will all pick up on that one piece of data. And then they'll all report it. And it looks like it's coming from multiple sources when indeed it's only coming from one source. And that's very problematic, because we think we're getting multi-sourced confirmed news, but indeed, according to this gentleman, we're not. I will say, by the way, that he certainly exhibited no bias toward, what I would consider to be, my perspective on politics and the news, which isn't to say that he agreed or disagreed with me, only that he wasn't overtly, he wasn't giving he wasn't doing this from a partisan perspective. He was doing his best to present this as just this is how news gathering works. So I think the same is somewhat true of the gathering of statistics and the reporting thereof. So we need to garner data from multiple sources if we want to truly know what's going on. So I'm going to start out today by sharing with you, if I can find it. Where did it go? Oh, here we go. Okay. So this is an alternate source for data on inflation, an alternative to the Consumer Price Index that's published by the Bureau of Labor Statistics. It's called Trueflation. You got to love the name, right? They want you to, this is the true inflation picture, right? So, and by the way, this is being updated, at least in concept, in real time. So let's just real quickly here. Let's put the valve there. Okay, so you see that there it goes. It pops up again. Okay, it didn't change. I mean, when they say, when it says real time, I don't know if they actually mean, sort of second by second or minute by minute. But in any event, according to Truflation, okay, the current inflation, what they call index, is 2.58%, and it's up 0.04%. Now it's a little bit weird because we think of up is good and down is bad, but and green is good, and red is bad. In this case, the red and the green refer to good or bad trend. So I just realized, let me open this up for you so you can see it better. There you go. Okay, so you can see that it's an up arrow, but it's in red because it went up 0.04%. So from Truflation's standpoint, higher inflation is bad. So up is bad. And if you look here over to the side where you see the producer price index, you'll see that it went down 0.5%, which is in green, which is good. So just the way they look at it, lower inflation, good, so green; higher inflation, bad, red. That's kind of a philosophical discussion, but just so we can understand at what we're looking. Okay, so, and by the way, and so then they put here below U.S. government reported rate 3%. That's got to be from August because the government hasn't reported a rate. So they're giving a comparison right there. They're saying the actual inflation rate is lower than what the government is reporting. Now, this U.S. inflation rate is based on their survey of a whole range of products and services. Okay, so let's take a look at this detail here. I think this is what it's going to show. Okay, so this shows you, this kind of shows you what has been happening from their perspective with inflation. In January it was up over 3%. It kind of hit its low point here on April 6th at 1.22%. And now it's been climbing since then, and it's now at 2.58%. Okay, so this is the true inflation rate. If we look at, I'd have to get a membership to look at these other ones. I may consider, doing that. So, this is an alternative. Let's look at let's see if they're going to give us composition. I think they are. Okay, so here's different products. So food and beverages, you can see, is at 2.5%. That's up from 2% a year earlier. Okay, let's see. Housing was at 1.57% a year ago. It's now at 0.65%. Transportation down from 3.89% to 1.88%. Okay, and this is these are as of today. Utilities, you can see, went way down, and now they're way back up. So they were at 7.56% a year ago. Now they're at almost 10.4%. Healthcare, okay, same kind of thing, although still at a much lower rate. So a year ago, a little under 3.4. Today they're at 3%. Okay. Yeah. Household and daily items. Okay, and you can see, by the way, why people are feeling pinched, because two things. I'm sorry, where was utilities here? That's what I was looking for. So utilities have even, they declined a lot, almost to zero, right, to 0.4%. In July, they were at half, like 5/100ths. Now they've jumped way back up to 10.39%. Okay. So that's going up pretty quickly. Household and daily items were lower at about 2.5%. Now they're back up here at over 4%. Okay. Alcohol and tobacco, I guess these are the sin, purchases, right? They were a little over 2% a year ago, 2.4. Now they're at almost 3.7, although they did spike above 5% at the very beginning of the year. Clothing, okay, was just a little over 1%. Now it's at over 5%, right? So a lot of the things, here's communication, is actually has been deflating from a year ago. It's at the same deflation rate. It did get up to about 1%. But communication doesn't look like it's a big factor according to this information. Education too has been about flat over the last year, even though it's kind of gone up and down. Recreation and culture, okay, it went from 1% to 2.74%. So not a whole big change. And then finally others, which is basically the things like personal care and product services. So they were at 3.2 and now they're at 3.15. So again, not heavily changed year over year. But you can see because of household and daily items where inflation has increased significantly, and utilities where, although it was at almost 8% a year ago, now it's at almost 10.4. So these are the kind of things I think that make Americans, feel pinched as we talk about, overall inflation. By the way, you'll notice down here relative importance. So this gives you an idea of, I think, the percentage they make up of budget. So food makes up a little over 7%, utilities almost 6%, housing 23%. Okay, food and beverages 15%. So between food and beverages and housing, that's 38. Utilities 44, other daily household items. Those four things make up 50% of household budgets. Okay, and while overall food the inflation rate on food has not increased very much year over year, other things have. Okay, but it is interesting. Housing has gone down to 0.6. Well, housing's gone down maybe 0.9%. So even though it makes up a huge amount of our budgets, the slowing of the increase in housing and the increase at which housing costs have increased hasn't really helped us out a whole lot. Okay, so this is the kind of alternative information that's available. And let's see, let's look at the fact sheet here so you can see what's here. Okay, so you can see, this week performance versus a week ago, 2.55%, up 0.03%, versus a year ago, it was 2.6%. So indeed, overall inflation has been pretty steady year over year, but you can see that it had gone way down and has come, way back up. And I think that's what most of us are feeling is we had gotten to the point where we felt maybe like, we were getting our budgets under control. But now, we're feeling them starting to increase again. And so that's problematic. Okay, so that gives you a sense of what's going on with inflation, even though, the consumer price index is not available. Okay, so now let's look at employment trends. So last month, we did look at the ADP National Employment Report. You'll hear all kinds of comments about it's good, it's bad, it's this, it's that. ADP is the largest payroll company in the world, I believe. They have a lot of data to draw on that they atomize, or I should say anatomize. They're not reliant on employers reporting data because they already have the employers' data themselves. So I think there's, there's good reason to be looking at the ADP National Employment Report. This is the employment report for October. Like with the Bureau of Labor Statistics data, it is published. It's reported, a month later, because the information has to be compiled and analyzed, etc. So, according to ADP, private employers added 42,000 jobs in October. Okay. Now, one of the differences between ADP and the Bureau of Labor Statistics is the Bureau of Labor Statistics posts job data for government and non-government, whereas this is focused purely on private employers. So, and while it has not been the case since President Trump came into office, if you were watching the show last year, you saw that it was growth in government jobs or government funded jobs that was really fueling job growth in 2024. Here in 2025, because the number of government jobs at the federal level has been shrinking, though offset by the growth in local and state government jobs, overall job growth has not been happening because of growth in government jobs. It really has been due to growth in the private sector. And so the fact that we saw 42,000 private sector jobs last month seems to me to be a pretty good sign. So you see here, last month delivered a rebound from 2 months of weak hiring, but the bounce wasn't broad-based. So education and healthcare, trade and transportation, utilities led growth. And for the third month, employers shed jobs in professional business services, information and leisure, and hospitality. Okay. Now, I will say that education and healthcare jobs, generally speaking, are fueled, shall we say, by spending that comes from the government. So part of kind of quote unquote government job growth is reflected in these statistics, but just not growth in actual government jobs. Okay. So you can see this chart, which starts in 2010. There was about 107,000 private sector jobs as of January 2010. Here in October of 2025, we have 134,571,000 jobs. So there's been an increase of about 28 million jobs over the last 15 years. More importantly, since 2022, there's been an increase of about 4 million jobs. Okay, let's see. Okay, so starting in January 2023, well, actually, let's go back to, here we go, October of 2022, 130,541,000 jobs. Now we're at 134,571,000. So there's been 4 million jobs created in the last 2 years. And let's look at, here we go. And in the last year, there's been approximately 1 million jobs created. That's why you're seeing this flattening out. Okay, so now, of course, there was a steep job creation coming out of COVID. That's to be expected. But the current trajectory, look at the height of the curve from, say, early 2010 through about 20 from till the end of 2018. That curve is somewhat like this time, and then like in 2019 and heading into COVID, things flattened out. We're seeing a similar flattening out now. Okay. All right. So change by establishment size. So the smallest businesses, 19 employees or fewer, lost 15,000. Interesting, though, 20 to 49 employees gained 6,000, but 50 to 249 lost 25,000, 250 to 499 up 3,000, and then 500 plus went up by 73,000. So it was large companies that are really driving job growth. The small and mid-sized is a much more mixed picture. And indeed, overall, these sectors saw job losses. So whether that's impacted because of larger companies, for example, can absorb the impact of tariffs more easily than small and mid-sized companies, or whether it's because of the uptick in inflation having, again, a bigger impact on small and mid-sized companies. Obviously, we don't know for sure, but those could be some of the factors. Okay. Where are we seeing job growth and declines? So natural resources and mining up 7,000. That would be things like oil production. Construction saw job growth. Manufacturing saw jobs decline. So, the Trump administration has been talking quite a bit about bringing manufacturing back to the United States, but at least so far, we're not seeing those job gains. I think it's unlikely that we will see significant manufacturing job increases in the short term. Factories have to be built, people have to be trained, etc. So that's just a factor of the reality of the economic reality of manufacturing. Okay, big gains in trade, transportation, and utilities, financial activities, and education and health services. Big losses in information and professional business services. So you can see services were really the movers. A smaller loss in leisure and hospitality, and a big loss in other services. Okay, so when it comes to goods, overall we saw gains. When it comes to services, overall we saw gains, but there were a number of sectors that saw job losses. Okay, so this gives you some similar data to what the Bureau of Labor Statistics reports. We don't have as much granularity as the Bureau of Labor Statistics shows in terms of, well, I think the sectors are fairly similar. Well, they don't break out retail trade, for example, and wholesale trade. Here they're aggregated. So there is some greater granularity in the Bureau of Labor statistics, but nonetheless, we can get at least a reasonably good picture looking at the ADP data. Now, let's take a break, and I'll come back and I'm going to show you another set of labor statistics. When life brings unexpected changes, managing inherited property shouldn't add to your stress. Magnum Properties specializes in probate and trust real estate management. We handle the complexities while you focus on what matters most. From property maintenance to tenant relations, from legal compliance to maximizing value, we're your trusted partner through every step. Magnum Properties, Inc., turning property challenges into peace of mind. Call us today at 213-264-4396 or visit magnumprops.com. Okay, so this is People Making Money, and I'm your host, Kevin Bemmel. We're doing our monthly Economic Echoes episode, and I was just talking about the ADP National Employment Report. Now I'm going to switch to the Paychex Small Business Report. Okay. Here we go. I want to make sure that's up. Yep. Okay. So now this is focusing on businesses with fewer than 50 workers. Okay. So we saw that segment in the ADP report. Okay. This is giving us, for those of us, and I think that's a lot of people who watch this show, we have smaller businesses. We may work for smaller businesses. So this is sort of drilling down into this particular segment of the job market. Okay, Paychex is, I believe, the second largest payroll supplier in the world. Okay, and like ADP, they have a tremendous amount of data upon which they can draw. They use aggregated payroll data from businesses with fewer than 50 workers. and they offer a monthly index measuring the change in small business employment. Okay, so here's how it works. They're looking at it on a year-over-year basis. Okay, so year over year from October of 2024 to October of 2025. Okay, if there had been no change in the number of jobs, the index would be at 100. Okay, if there had been a gain in jobs, the index would be over 100, and if there was a loss in jobs, then it's under 100. And you can see the index is 99.27. Okay, so they're showing a 12 months change of 0.79. These numbers don't exactly add up. There's probably some rounding errors in them. Okay, but what we're seeing is that there have been job losses year over year among small businesses. Okay, and if you're looking at the 3-month national trend, so in August, there were some very slight gains, but September and October have been 2 months of job losses for small businesses. Okay. And you can see here's the historical jobs trend index, setting aside, the COVID period here. The index has been bouncing around 102, 101 to 102 since 2014, and then sort of post COVID, it's the same thing, 101, but now it's for the first time in about 10 years, it's dropped below 100. So it dropped below 100. It looks like as of March, it hit 100 in February, but as of March, it dropped below 100. April, it went back up to 100.02, but since then, it's been below 100. So in terms of hiring, smaller businesses are definitely, they're not the engine of job growth that they have been in the past. Now, this is giving us a regional performance. You can see that small job declines in the West were the greatest. Okay, in the Midwest second, Northeast third, and in the South just a quarter tick down. Okay, so the South has really been the strongest, meaning that they've lost the fewest jobs in the small business sector. Okay, so state performances, which is probably more relevant to us. So the state with the largest job growth, okay, was North Carolina. And you can see here it was led by strong gains in leisure and hospitality and construction, 103 in both sectors. Okay, Ohio ranked second with 100.66. Okay, Tennessee ranked last with 97.68. However, you look at West Coast states like California and Washington, they weren't much better. There's been, and I can tell you as someone who owns a small business in California, it is very difficult to run a business here. The taxes are high, regulation is high, which is why the state has seen losses. So Maryland has also seen job losses, as has Massachusetts, Virginia, New Jersey, okay, and New York. All of these have seen job losses. In fact, here's 100, okay, this line right here. So you can see, even some states in the Southeast, Georgia, Florida, have lost jobs. However, most of the states that have lost jobs are states with high levels of taxation and high levels of regulation. So Massachusetts, Maryland, California, Washington, New Jersey, New York, and Michigan, and Illinois. Okay, the outliers are Tennessee. That's kind of strange. Tennessee is not known for being a highly regulated state. I'm not sure what exactly is going on there. And Missouri and Wisconsin also not necessarily known for being highly regulated. Now, the best performing states, again, North Carolina, Ohio, Arizona is doing well, Pennsylvania, Texas, Indiana, Texas, and then Georgia does just not quite makes it to 100, okay? And Florida also not quite making it to 100. So that gives you the breakdown in terms of, again, this is small businesses. Now, looking from a metro area, okay? So Phoenix did the best, okay? But Phoenix is the only metro area that was over 100. So this is these are large metro areas, by the way. So what we're seeing here is large metro areas are losing jobs. Denver is at the bottom, 95.5 basically. Riverside, California, 96. San Francisco, 98. Los Angeles, 98. Seattle, a little over 98. Washington, D.C., 98 and a quarter. Boston, a little over 98 and a quarter. San Diego, not quite 98 and a half. Baltimore, 98 and a half. So you can see all these large metropolitan areas. The only one that's gaining jobs in small business is Phoenix. Miami just fell short of breaking even, but from then on down, Philadelphia, Chicago, these large metro areas are losing small businesses. And if you look around large metropolitan areas, you can see, for example, in things like retail and restaurants, you see more and more and more and more chains, fewer and fewer local businesses, okay? And you can see 13 of the top 20 metro areas reported a job index below 99, okay? And you know, that's very bad trend for major for metropolitan areas. Okay, industry performance. So health and education services saw gains of 100.6 basically. Okay, again, because this is supported by government spending, that isn't so surprising. All the other sectors with respect to small businesses lost jobs. Now, financial services, just barely, they're at 99.77. Other services, 99.63. Transportation, trade, transportation, utilities, 99.5. So there weren't big ones, but you can see once you get down to manufacturing, they're at 99. So, you know, essentially like, you know, that's a 1 percentage point drop. Okay, construction overall for small companies saw about a 1.3% drop. Business and professional services, 1.4 drop. Leisure and hospitality, about a 1.7% drop. Okay, this is looking at it year over year. So small businesses are just not, according to the Paycheck survey, they're just not the engines of job growth that they have been in past times. So I want to look at something right here, make sure that I did not lose you. Okay, good. Yeah. All right. So now let's next look at median housing prices. And here we go. Okay. So this is the California housing market overview. Okay, this is compiled by Redfin. Again, these Redfin, Zillow, they have a tremendous amount of data to draw on. Now, these we've looked at every month for quite a while now, because there is no government data published on these kinds of sectors. So this is interesting. Home prices in California were down 0.13% year over year in October. At the same time, the number of houses sold rose 3.6%, and the number of homes for sale rose 6%. Okay, so that's good news for those of us who live here in California. Median days on market has increased. Number of homes sold has increased as well, but the average price went down just a teeny bit. Okay, so we're still, kind of in the, mid 800s level where they've been now for, the better part of a year and a half. Okay. After from the end of November being down below 800, I would say it's probably unlikely that we're ever going to see that low a median home price here in California. Okay. The top 10 metro areas in California with fastest growing sales prices: Mission Viejo, almost 20%, Seal Beach, 18, Redwood City, 18, El Dorado, almost 18, San Mateo, 18, and on down. And then we get into Costa Garden Grove around 10, Whittier 10, and South Lake Tahoe. But so some areas are seeing large increases. Okay, housing supply. I mentioned this a moment ago, up 6%, the number of homes per sale year over year. Okay, number of newly listed homes is actually down 5% year over year. So there's just, there's homes, they're hanging on the market longer. And so even though the number of new homes being listed has slowed, homes are just not selling as fast as they were. And so you're seeing overall an increase in homes for sale. Okay. Housing demand. Okay. The number of homes sold above list price, 34.1%, down 6.6% year over year. Homes sold with price drops, 28.3%, up 3.5%. Sale to list price, it's still pretty close, but it's still, homes are selling overall for less than list price. And again, that's showing that there's some, at least a little bit of softness. Okay. The 10 most competitive cities in California, you see them listed there. And here we go. US migration trends. So this shows you where are people moving from the states. The bluer the state, the more people are leaving that state. So you can see California tops the list, followed by New York and Illinois, and then a number of other states: Washington, Texas, Louisiana, Georgia, etc. Okay, where are they moving to? Again, Florida tops the list, followed by Arizona and North Carolina, Tennessee, and South Carolina, Idaho to a lesser extent, and Wisconsin and Michigan. And then, Ohio and all the rest of the states are seeing very small increases. And you look at Texas and you say, wait, I thought Texas was gaining. So, okay, more than 2,000 people were searching to move out of Texas. Okay, so this is what this is based on, is where people are located and where they're searching homes. Okay, so it gives you a sense. What are the urban areas that people are most looking potentially to move out of? Okay, well, Los Angeles is number one, New York City number two, Washington, D.C. number three, Seattle, San Francisco, Chicago. And then you see there's a big drop after Chicago when you get to Atlanta, Hartford, Houston, and Dallas. Okay, and where are they looking to move to? Well, Sacramento has topped the list for a number of months now. I think it's people leaving other places in California to stay in California, but get into a smaller metro area. But then after that, you're looking at Arizona, and you'll notice 3 of these cities are in Florida. That pretty much stays with trends. And by the way, you can search. We can look at Los Angeles. Okay, here's the Los Angeles housing. So you can search any housing market that you want, and it has many of these same statistics. Okay. And so much for my theory that people from Los Angeles are moving to Sacramento. Evidently, that's not the case. Primarily, they're moving to Houston, Texas, at least from August 25 to October 25. So it's for the previous quarter. Okay, but you can search any, and all of these links, as always, will be in the show notes, so you can take a look at them. Okay, so that's the for sale housing market. Now let's take a look at the rental housing market. Okay, so this is compiled from data from Zillow Rentals. Okay, and this shows you 10 of the major markets that we can look at, but you can search any market you want. Okay, if I look at Los Angeles, my hometown, okay, month over month and year over year, rents have gone down. Okay, you can see this is the breakdown of price range. how many rental properties there are in a particular price range. You can see there's a lot of $5,000 plus rentals in Los Angeles. That shouldn't be so surprising. The rental market temperature is cool in Los Angeles. By the way, you can compare any two markets you want. Okay. And, you can look across all these markets. You can see rents have been relatively flat for the survey period. Okay. Let's look at, I think I usually look at Omaha. Oops. I got to say Omaha. Okay. I will learn to spell. There we go. Omaha, Nebraska. Okay. So Omaha, Nebraska, month over month went down a little bit, but year over year is higher. Now, look at the different profile in terms of units available. Almost everything in Omaha is at, is below $3,000 a month. So even high end. So there's not a huge, super high end market like there is in Los Angeles, which makes sense. Okay. The market temperature in Omaha is also cool. Okay. And you can see how segments of the market compare. Let's look at one more. I think I typically look at Miami. Okay, Miami, Florida. Okay, Miami, Florida, like Los Angeles, has a huge number of $5,000 or more per month units. Okay, the temperature in Miami market is warm, right? So Florida still continues to be a destination for people to go. And you can see, for example, in Glenvar Heights, the graph is going up. Okay, Westwood, it went down, but it's come back up again. Westwood Lake. So you can look at any rental market you want to get a sense of what's happening with rental housing prices. Okay, and you can compare them if you're thinking you may, want to move. All right. So the final thing I'm going to look at is are the indices of consumer sentiment published by the University of Michigan. Okay, and this gives us a sense of how people are feeling about the economy. Okay, so the index of consumer sentiment is down in November to 50.3 from 53.6. Okay, that's a significant drop. And of course, it's a huge drop from a year ago when it was 71.8. So just post-election, people were much more positive about the economy than they are now. And there has been a lot of economic turmoil over the last year. Okay, now, current economic conditions, they're slightly better sentiment. So 52.3, still down from last month and down overall year over year. Okay. And then the index of consumer expectations down just slightly from last month, 50.3 to 49, but again, down significantly. So again, there was a lot of high expectations after the election. You can see it was at almost 77 in November of last year. Now it's down by over 36% to 49. We'll have to see how that plays out. Expectations for inflation, generally speaking, are moderating. Okay, so year ahead inflation expectations inched up from 4.6 last month to 4.7 this month. Very small change. Long run inflation expectations actually declined from 3.9% last month to 3.6% in November. Okay, so overall, while inflation expectations have moderated or declined, it's the overall economic picture that people are about which people are concerned. And I think that reflects in some of the headlines we're seeing in the news these days, where stores are concerned about holiday sales. We're seeing lack of job growth among small businesses in particular. So all of these things give us a sense of what's really going on in the economy, and more specifically, which is what this show is all about, what's going on in our own economy, right? I've mentioned this periodically. A recession is when our neighbor loses his job. A depression is when we lose our job, right? Kind of all joking aside, though, the economic data is important to us largely insofar as how it affects our individual circumstances. Okay. And so as you look at, as we talk about the data, as you look at it, all the links are in the show notes so you can spend some time sort of focusing down on your specific location. Hopefully that will help you make better economic decisions as we head toward the end of 2025 and start getting ready for the new year 2026. So if you have any questions, comments, criticisms, all of my social media links will be in the show notes. Feel free to post them or send them to me, because my email address is there as well. And if you know someone who you think would be interested in learning about this information, I'd really appreciate it if you would send them a link to the show, and I'd love to have the chance to gain them as a subscriber. So let's see. Tomorrow at 5 p.m. Pacific time is my show Jiggers' Place. We'll have a cocktail and a schmooze as we head into the end of the week. So I hope you'll join me there. And then next week, which is Thanksgiving Day week, I'll have a regular slate of shows, all at 10 a.m. Pacific time. Trust and Estates Weekly on Monday, Business Lessons from the Military on Tuesday, and the next episode of People Making Money next Wednesday. So I thank you again for joining me, wishing you a wonderful rest of the day, and signing off as I always do. Marie, darling, you are my belle. Courage at all times, my friend.